Welcome students. We have discussed in the previous section that the free cash flows are independent from each other, independent from the capital structure decision in a profit capital market. The free cash flows are independent. It is not to do anything with the capital structure mix. So here the example is being provided like the same coffee shop example is being taken. The middle one we have discussed, that is expected free cash flow, we have discussed 34,500. Now the economy may go weak, the economy may go strong, it might be expected as it is 34,500 we expected. If it goes weak, what happens to the levered unlevered situation? And if it is economy is stronger, then what happens to the cash flow? Here we have taken different kind of debt equity mix. To show this in a better way, better format, let's go to the financial modeling that spreadsheet. Here you see the spreadsheet is talking about the font in blue is all given data. Cash flow in weak economy is 27,000. Cash flow in expected economy is 34,500. Cash flow in best economy is 42,000. Your cost of debt given in the question is 5%. Total capital is 30,000. Now 8.3%, this 5%, the 8.3 I will tell you a little later. I will come back to that. Now different capital structure mix, because we have a spreadsheet, so we have the freedom. What I have done here, I have taken different capital structure. What are the different capital structure? What do I mean by that? The level of equity. Level of equity. I have taken the level of equity as I have taken the level of equity 100%, 80%, 50%, 20%, and 10%. If level of equity is this, then debt will be equal to, if equity is 100%, debt will be 0%. If equity is 80%, debt is 20%. If equity is 50, like that, debt equity mix will be there. Now, if 100% equity will be there, then it will be 30,000, right? 30,000 is the total capital, all 100% equity. If equity is 80%, then 80% of 30,000 is 24,000 will be the equity. If it is 50%, 15,000, 6,000, 3,000, like that. If debt is if equity is 30,000, debt will be 0, because total capital structure is 30,000. If debt is if equity is 24,000, debt is 6,000. If equity is 15, debt is also 15. If equity is 6, debt is 24. If equity is 3, debt is 27. So whatever percentage you want, you can change here. For example, you want to make it 30%, you can make it 30%. So automatically the debt equity will be 9,000 and the debt will be 21,000. Because the question has explained 20%, so I just brought it 20%. So now question is cost of debt. Cost of debt is 6% on the total debt. So in the first scenario, cost of debt will be 0, because there is 0 debt. So 0 debt means 0 interest. In the second case, 6,000 debt means 5% on 6,000 is equal to 300. In the third case, debt is 15,000. So 5% on 15,000 is equal to 750. We have seen the cash flow scenario that 750 was being paid, right? Here, 15,750. Why? Because 15,000 was the debt, 750 was the interest. Only one cash flow is explained here. We are going to see all the mix here. Similarly, all the debt cost is calculated. But once the debt is increased, if the equity is 10%, debt is 90%, debt cost is increasing to 8.3%. It will not remain 5% constant because your company has got too much of debt. So no one is ready to give you debt at 5%. So the new debt, once you are increasing the debt to 90%, equity 10%, then your debt cost will be 8.3%. Then your cost of debt will be 2241. That is 8.3% of 27,000 is equal to 20, once your equity only 3,000, debt will be 27. Too much of debt, 90% debt. So your debt cost increased to 8.3%, and 8.3% of 27,000 is equal to 2241. Now question comes, cash flow to the debt holders is equal to the debt plus the interest. In the 0% case, it will be 0. In the 6,000, 20% debt means 6,000. It will be 6,300. 6,000 is the debt, 300 is the interest. Like that, all the cost cash flow to the debt holders are being calculated. Then cash flow to the equity holders will be the total cash flow minus cash flow to the equity holders will be, if it is weak economy, in the weak economy, what is the cash flow? 27,000. So 27,000 is the total cash flow. Out of that, debt holders will take 0, then 27,000 remains with the equity holders if it is 0 debt in a weak economy. If the debt is 20%, weak economy, you will get 27,000. Out of that, debt holders will take 6,300, then equity holders will get 20,700. If it is weak economy, your debt holders are 50%, then they will take 15,750 out of 27. Remaining equity holders will take 11,250. This is being shown here, 11,250. Similarly, it is the expected economy is shown here. I am showing you the weak economy now. If debt is 70%, equity is 30%, debt holders will take 22,050. Equity holders will take only 4,950. How? 27,000 minus 22,050 is equal to 4,950. If debt is 90%, they will take 29,241 out of 27. So equity holders will get negative 2,241. That means equity holders' capital will be reduced by 2,241 loss. Now come to the percentage. If what is the theory we have learned in the theory section? We learned that leverage increases the cost of equity. See the last sentence. Leverage increases the cost of equity. Now we will see how leverage increases the cost of equity. See here. In the weak economy, without having any debt, your cost of equity was 10%. Right? Lost 10%. How lost 10%? You invested 30,000, you got 27,000. So that means you got minus 3,000. So minus 3,000 is 10% of 30,000. You have increased debt to 20%, equity 80%. What is the theory? With leverage, cost of equity increases. See the cost of equity here, 13.75. You further increased the debt. Debt became 50%. Here debt became 20%. Here debt became 50%. Once from 20 to 50 you increase the debt, the cost of equity also increased from 13.75 to 25. Further increases the debt. Here debt is 70%. So the cost of equity became 45%. And here cost of equity became 175%. You see, 10% when it was all equity, 13.75 when 20% debt, 25% when it is 50% debt, 45% when it is 30% debt, 70% debt, and 174% or 175% when it is 90% debt. So debt increases the cost of equity. Now let us see the cash flow in the expected economy, which is given in this PowerPoint. This is the expected economy scenario is given here. Of course, I have given in much detailed way so that you can get clarity in the picture. You see, cash flow to equity holders in the expected economy, how much? 34,500. Where it is given? Here it is given. Cash flow in the expected economy is 34,500. Very good. Fantastic. So, if there is no debt, no one is to share the cake. That's why all 34,500 comes to the debt holders. If there is 20% debt, 80% equity, then out of 34,500, debt holders will take 6,300. Remaining is 28,200 goes to the debt holder, which is 17.5% return. If debt is 50%, then they will take how much? They will take 15,750. Then equity holders will, the remainder with equity shareholder will be 18,750. 18,750. See, 18,000 levered equity, 11,250, 18,750, 26,250. So 18,750 in an expected economy. So 18,750 goes to the equity shareholder. What is the percentage? The percentage is 25%. Same like if the economy is expected economy and debt holders are 70%, they will take how much? 22,050. 34,500 minus 22,050 remains is 12,450. That is equal to 38.33%. So, again the theory, go to the theory. Debt increases the cost of equity. See here, with no debt, cost of equity was 15%. With 20% debt, cost of equity was 17.5%. With 50% debt, cost of equity 25%. With 70% debt, 38.33. With 90% debt, 75.30. This is on expected economy. When the economy is best economy, when economy is best, then you get cash flow of 42,000. If it is no debt, all 42,000 goes to the equity holders. Just a minute. Yeah. So, best economy, if no debt, all 42,000 goes to the equity holders. That is again 40%. If economy is best and debt is 20%, equity is 80%, debt holders will take 6,300. From 42, 6,300 once deduct 35,700 goes to the equity holder, which is 48.75%. If it is 50% debt, debt holders will take 11,250. Debt holder 15,750 debt holder will take 15,750 deduct from 42,000 will be 26,250. That is equal to 75%. So again, theory is when you increase the debt, your cost of equity goes up and up. 40, 48, 75, 121, 325. Now let's go to the. So I think this is clear. We have done the graph here, taking this data. Yeah, the graph is calculated here. So these are the kind of cash flows. The summary cash flows: weak economy, expected economy, strong economy, and cash flows are 27, 34,500, 42,000. Debt returns are 5%. Equity returns are given here. Unlevered equity returns are given here from this table. Summary tables are given. Next is, suppose you borrow only 6,000 when financing your coffee shop according to what should be the value of the equity P? What is the expected return? Already we have taken 6,000 means 20% debt, 80% equity. We have done here 20% debt, 80% equity. If you have done that, and this coffee shop, once you have 20% debt, what will be the scenario? The debt holders will take 6,300. Then In expected economy, what will happen? Equity holder will take 28,200. Why 28,200? 34,500 will be the total cash flow. Out of that, debt holders will take 6,300, remains 28,200. Then the cash flow is 17.5. 17.5. See, 17.5 is the return of the debt holders, equity holders. You see, when there was no debt, equity cost of capital was 15%. When there is debt 20%, cost of equity increased to 17.5. When debt is 50%, cost of equity will go 25%. We have seen in the previous slide. Now we will see the leverage. What happens homemade leverage? That means investors use the leverage in their own portfolios to adjust firm's leverage. A perfect substitute for the firm leverage in perfect capital market. How we do that? Weighted average cost of capital is equal to the debt divided by total asset multiplied by cost of debt, that is equal to weight of debt multiplied by cost of debt plus weight of equity multiplied by cost of equity, that is equal to WACC. Now, as per proposition 2, what has said? Is saying that whatever will be the cash flow remains the same. Here, cash flow is 27,000 in a weak economy, 34,500 in an expected economy, 42,000 in a best economy. That remains fixed. Keep it in your mind. Now, the debt and equity holders, they share the kind of cash flows as per the agreement. Here the agreement is 5% on the debt holders. So whatever the cash flow will come, debt holders will take 5% of that. Here 6,300, 15,750, 22,050, 22,940, 29,241, as per their interest rate, they will take their money. Whatever remains, that will go to the equity shareholder. And in this process, the cost of equity capital increases along the debt is increased. Why? Because of the risk they are taking. So once debt is increased, cost of equity will go on increasing. We have seen here. Without debt, it was 10%. With 20% debt, it became 13.75 during weak economy. Loss. Profit also increases, loss also increases. So cost of capital basically increases with the debt. Same in an expected economy, without debt 15%, with 20% debt 17.5, with 50% debt 25, with 70% debt 38.33. And if it is, for example, we will make it 20% equity, for example, 80% debt, then that is 55. See, 15 to 17.5 to 25 to 55 to 75. So the cost of equity goes on increasing once you increase the debt level. And now proposition 2 will come. As per proposition 2, the cost of levered equity is equal to cost of the unlevered cost of capital plus debt equity ratio multiplied by the premium, that unlevered cost of capital minus debt cost of capital will be equal to the levered cost of equity. You can see here that the yellow line is talking about the cost of debt, and the below line, that is the magenta line, is talking about the cost of debt. You see, the cost of debt is 5% throughout the line up to 90%. Once 90%, cost of debt increases. We have seen in the sheet here. The cost of debt was 5% up to 90%. Once it is 90%, cost of debt will be 8.3%. And the cost of equity you see here, once you are increasing 10%, 20%, 30%, the cost of your equity is increasing, skyrocketing. and the WACC remains same throughout the 100%. Whether your debt equity mix becomes 0% or debt equity mix becomes 100%, all scenario the WACC remains 15%. How it is so possible? Let us see here. You see, here WACC is 15% in all the cases. See, in 100% equity, in 80% equity, 50% equity, 20% equity, 10% equity. In all situations, your WACC is 15%. What is the WACC formula? Debt divided debt plus equity multiplied by cost of debt, equity divided plus equity, cost of equity. So the equity formula, and we have calculated the cost of equity here through the percentage return. Here through the Modigliani-Miller formula, we calculated the cost of equity. RE as per the MM formula. Interestingly, it matches with this. You see, 15%. Here the formula also gives 15%. 17.5%. Here formula also gives 17.5%. 25%. The formula also says 25%. 55% matches with 55%. 75.3, 75.3. And what is the formula? The formula is equal to cost of levered equity is equal to cost of unlevered equity plus debt divided by equity multiplied by cost of unlevered equity minus cost of debt. That will be equal to the cost of levered equity. And you can see all scenarios we have used the WACC formula, and it came to 15% in all the scenarios, worst, best, and average. You see, in WACC in expected economy is 15% throughout the capital structure. WACC in weak economy minus 10% throughout the capital structure, and WACC in the best economy 15%. Here the expected one is not taken, that's why it is coming, or else it will be 15% only. Here the cost of capital changes, right? So this way, here I'll just suppose you borrow 6,000 when financing your coffee shop. According to MM proposition 2, what will be the firm's equity cost of capital be? In all cases, it is 17.5. You see, if you are having 17.5% as per formula, here we calculated as per the return. Here as per formula, we calculated 17.5%. And MM and the real world, capital markets are not perfect in the real world. How does this impact the MM results? You know, there will be tax, which will be definitely a tax seal instrument. So your tax budget is saved because of interest. That is not included in this particular scenario. Why? Here MM says the market is a perfect capital market where tax is not there. So that we will see in the next section. Before that, I'll stop the recording here.